Hi there, welcome to Kneppy Invest. A really interesting week on the Australian markets. In fact, the XJO has closed at an all-time high, 7,699.4. Fairly bullish week after being up 1.81% last week, up another 1.91% this week, and has broken above a really important resistance level, which was around about 7,632, which was the old highs we saw back in August 2021. The XJO has tried to get above this level about 4 or 5 times in the past 2.5 years and has failed until now, possibly. Now, I'd like confirmation that this is a breakout. And to get that confirmation, we can't see any big down days at the start of next week's trading week. So if we see the XJO down 1.5% on the Monday, then another 1.5% on the Tuesday, this could be a false breakout, just like we saw gold a few months ago. But all-time high for the XJO. And right now, the bulls are beating the bears. Still a lot of bears out there thinking we're headed for really bad times on the markets. But today I have been talking about that for the last year or even 2 years. And hopefully they're not in cash, and hopefully they're taking a little bit of advantage of this nice little run in the XGO since October. In fact, the XGO has increased from 6,800 to 7,700. So we're talking about, what was that, 6,800, 900, a nice little 25% or 25% rise in the XGO just in the past 3 or 4 months. Really interesting last 3 trading days of the week. A lot of volatility because the XGO was up 1% on the Wednesday, down 1.2% on Thursday, and then up 1.47% on the Friday to close at the all-time high. And you see that sort of volatility when the market's unsure of itself, when there is a fight between the bears and the bulls. But right now, it does look like the bulls are winning. Now, to be honest with you, if I had to guess who was going to win in the end, I'd always put my money on the bulls. Why? Because over time, equity markets go up. So you're just betting on probability that over time, no matter the time period, the equity market you're looking at will be higher than it is right now. So you're just betting on probability. So I don't know what probability that is, 50%, 60%, 80% chance. It's going to be higher than 50% more than likely. But over time, the XGO does rise. It might take a while for the XGO to get to the new high. So we have been waiting 2.5 years, but eventually it will. That's the nature of equity markets. And that's why we invest in equity markets, because over time it goes up. Now, some interesting announcements have been released during the week. And the whole reason I'm doing this video today is to go through some of these interesting announcements. I have included 18 companies in today's video. Now, the last 2 companies are really interesting companies, sort of a sad story and a not so sad story about companies going into administration. So wait until then to hear what I have to say about these 2 companies. One company has gone from administration to liquidation. Another company has gone from administration and control of the company has gone back to directors. So some investors believe when a company they own goes into administration, that's it. That's the end of the story. It's not necessarily true. Sometimes a company that has gone into administration can rise from the ashes of administration and be better for it. But sometimes they don't. Sometimes they go into liquidation and they are no longer a company. So those will be the last 2 companies I'll talk about in today's video. Now, the first company I want to look at is Bapcor, a company I have owned in the past. And to be honest with you, the share price of this company has gone nowhere over the past 7 or 8 years. In fact, we can look at that just by looking at the weekly chart for this company. So Bapcor sells car parts, stuff like that. Majority of the car parts are sold to commercial and wholesale, if I remember correctly, but they do have retail division as well. And there is some really interesting thoughts about this company out there. So we do have some bears and we also have some bulls. The bears are sort of obsessed around how this company is going to be negatively affected by the electrification and EV vehicles. And the bulls are saying, hey, wait on a minute. This transition is going to take a long time. And the other thing is Bapcor is not, you wouldn't, they say you shouldn't define Bapcor as consumer discretionary because it doesn't sell a lot of their stuff to consumers, that sort of thing. Who knows? I don't know. Anyway, so share price of this company has done nothing over the past 10 years. This is the weekly chart. So if you go back to August of 2016, share price is the same level it is right now. In fact, it was a little bit higher. So yeah, so this could be because two reasons. This could be because the company's not growing anymore. If you look at the revenue and the profit, maybe those are going sideways and there's actually no growth in this company. Another reason why the share price might be going sideways over a long period of time is because the company, even if it is growing its revenue and profit, is going through a period of multiple contraction. The PE ratio of the company is going down through time, which actually does make sense if the bears are right that there is going to be less growth in this company in the future. The market is less willing to pay a premium for the company. So the way that works is back in 2016, and this is just hypothetical, possibly the PE ratio of this company was, say, 25 to 30. Now it's maybe 15, and that's why the share price has gone sideways, even though the company is growing. And in fact, I could have a look to see if the company is growing just by TradingView. So if you look at the last, they have 5 years of history down here, and revenue has been increasing 1.3 billion to 2 billion, and profits gone from just under 100 million to just above 100 million. So profit slowly increasing. So there is a little bit of multiple contraction happening with this company. And again, the reason why that's happening is the market is less and less willing to pay any sort of premium for this company because they do maybe not fear for the future of this company. They just think because of electrification, this company will have more trouble growing in the future. However, the company did release a trading update during the week and the market liked it. And the market liked it, and I thought it was okay. So okay growth. So the trade wholesale up 3%. You can actually see how much bigger the trade and wholesale is compared to the retail. So in the first half of this year, 862 million trade and wholesale, and only 214 million for retail. And in fact, trade and wholesale up 3%, but retail down 3%. And overall revenue up 2% because trade and wholesale is a bigger part of the business than retail. So okay growth, 2% revenue growth, possibly that beat market expectations. So even though you might think, well, revenue growth, only 2%, why did the market get excited? It could have significantly beaten expectations. Possibly the market expectations were that revenue was going to drop 5%. I don't know. And pro forma EBITDA down between 3 and 1%, and pro forma profit after tax down 15 to 13%. So again, more than likely, the reason the share price of this company went on a little bit of rally, not a big rally, was because those numbers beat market expectations, not because they're really good numbers. So profit decreased from 62 million to between 53 and 54 million. So if you just looked at numbers in isolation, you would think the share price would have plummeted, but that's not what happened. In fact, the share price rallied, if I remember correctly, about 6%. Yeah, up 6%. The previous day, trading day share price was 527. Now it's 566. Now, would I trade Bapcor? So what I'm looking for here is a positive financial result. Yeah, you can say this is positive, beat market expectations. I'm looking for a breakout in the share price that coincides with a positive financial announcement. So I'm looking for at least a 6-month high, preferably a 1-year high. And I'm also looking at some increase in volume. So do we have that with Bapcor? And the answer is no. And why? Is because the share price has gone down. In fact, if you look at 6 months ago, the share price of this company was higher. So if you go back to August, the share price was $6.20. In fact, the share price rallied all the way up to $7 in September. So definitely not a 6-month high for Bapcor. So no interest in trading this company right now. Now, it's a little bit of a different story if you're thinking this company is cheap at current prices. That's a completely different story, but I'm just thinking of whether this company is a trade right now. And you can see the share price dipped a lot in 2 consecutive days in October, down 11.5% on the 17th, and down another further 7.6% on the 18th. So something happened there. Might have been around the AGM. So no breakout when it comes to Bapcor, even though the market liked this trading update from the company. Now, on to another company called Mitchell Services. I have held this company in the past as well. And I've always thought this company was cheap. In fact, one of the videos I did in this company was in terms of, is this one of the cheapest companies on the ASX? Just by looking at some of the numbers. But even if you do think a company is really, really cheap, the market might think otherwise, and the market could think otherwise for 5 years, the share price does absolutely nothing. And that's why I actually sold out of Mitchell Services, because of exactly that. I thought it might have been cheap. The market thought differently. And I listened to the market and thought, well, there's no point having a holding in this company, because I could be waiting 5, 10 years. I could be waiting forever. Now, the company did release a trading update. They're also doing buybacks, as you can see here. So investor update, they tend to release these quite often. And my first thought, as soon as I read this, I thought, oh, this looks pretty positive. So this company has a market cap. How much is the market cap of Mitchell Services? I'm thinking 90 to 100 million. 74 million. I think that might be a little bit low. So 74 million, according to TradingView, it has a market cap of 77 million. So we'll say 75 to 80 million. So that's a little bit lower than I was thinking. So keep that in mind. This company has a market cap between 75 and 80 million. Now let's have a look at the numbers. Quarterly numbers. Quarterly revenue of 57 million. Quarterly EBITDA of 8.4 million. So this is quarterly again. So if you sort of times that by 4, you get an EBITDA of sort of a yearly basis of 32 million, which means this company is trading just above 2 times EBITDA, which does seem ridiculously cheap. Quarterly operating cash flow of 14.1 million. That does seem pretty high for a company that is trading at a market cap of 75 to 80 million. They also decreased their net because of that operating cash flow. Net debt has been reduced by 48% since the 30th of June 2023, down to 9.1 million. Not sure how much cash they have on hand. So there is a possibility, if they have more cash on hand than debt, this company has an enterprise value below or lower than 75 to 80 million. Profit, first half profit between 4 and 4.5 million. So this company would have a fair bit of depreciation because they are a rig company. And you would think that rigs are highly capital intensive. And interim dividend of between 1.5 and 2 cents. So interim dividend, you could say maybe the full dividend, 4-year dividend will be, say, 2 cents. So this company probably has a dividend yield of greater than 10% based off the share price of 34 cents. In fact, the dividend yield, according to CommSec, is 6%. So let's have a look at the dividends. Just see if that's a big increase on dividends. So the last dividend they did relate, 2.1 cents. So dividends have really increased. So that 2023 dividend was the first dividend for 3 years. So there is potential that the dividend yield for this company could be really high, above 10%, because of this interim dividend. So I'm just speculating that the final dividend will be greater than 1.5 to 2 cents. So just by looking at the numbers here, this company still looks ridiculously cheap. Now, there were a couple of concerning things when I looked at this particular table. So average operating rigs down, number of shifts down, revenue down, but they've just been more efficient with how they've turned revenue into EBITDA and profit, because even though revenue's down, EBITDA is up, operating cash flow is up as well. So a few things to like about this company, a few things to be wary about, particularly with the average operating rigs and number of shifts. So how did the market react? It did not react all that much. In fact, the share price down during the week. Share price has gone from 37 cents to 34 cents. And the main thing about this company, and we'll go back to what I'd said in regards to Bapcor, whether that was a potential buy based off some of the rules I have initiated. And the first rule is, was this a positive financial report? You could argue this was a positive financial report. Is this a breakout? Well, the share price has actually gone down, which by its very definition, this cannot be a breakout. If anything, it might be a breakout to the downside. This could be a selling situation. And is there any increase in volume? In fact, decrease in volume over the past few weeks. So the chart does not look good for Mitchell Services. Weekly chart does not look good. We have a developing triangle pattern here. If the share price got down to, say, 27 cents or so, I might become interested. That could be a little bit of a value play. So only 7 cents above that level. But you'll notice over the past 5 years, so the high share price high for this company was back in May 2019 at about 70 cents. So share price has halved since then. And each time the share price gets to not a new high, it gets to a lower high than the previous high. That high is lower than the previous high. So we're seeing lower highs. That's actually a negative thing. So not a good looking chart for Mitchell Services. Probably the only thing going for this company is it does look really cheap. It still looks cheap, but just because it looks cheap doesn't mean the market is going to be interested in the company. Perpetual. I almost forgot why I included Perpetual in this video, and then I remember there was just a little comment they had in their announcement. So Perpetual are a fund manager. They released a second quarter business update, and I would have totally bypassed this particular announcement apart from one snippet of commentary. And this was actually a really interesting bit of commentary from the company's CEO and managing director, Rob Adams, which I want to zoom in, not zoom out. And this is what he said, which I found really interesting. You might not find this interesting, but I found it really interesting. It's this bit here. The December quarter was a difficult period for active asset managers globally, being the worst quarter in 15 years for active equity fund flows. Now, I think this is sort of the beginning of the end for fund managers. I actually think, or even asset managers, I think there is a future where these sort of companies don't exist anymore. I don't know when that's going to be. I don't even know why any investor would put their money with these sort of people, these companies, because you can just buy ETFs. ETFs are taking over from fund managers, even asset managers. And I think that trend will continue on force over the next 5, 10, 20 years. So I think these sort of worst quarters in 15 years are going to be quite common for these type of companies. Otherwise, I don't even remember going through this announcement at all. I think they would have said of funds, whilst the net outflows of 4.3 billion, sounds a lot of net outflows, in our asset management business was disappointing. It was pleasing to see our total assets under management rise slightly to $213.9 billion. How did the market take it? This is the most important thing. 29th of January, share price dipped a little bit, 2%, and overall the share price has dropped from $26.20 to $25.52. Now, would I think this is a trading opportunity? I was keeping a little bit of an eye on this company because there was a potential, just a potential short-term breakout. So this is what I mean. So we go to the last highs we saw back in June of last year. Just draw a line there. And if you just take that line back further, we go all the way back to February of last year. So there was a potential if the share price of this company got above about $26.50, that would be a one-year high. And what I'll be waiting for in this case for a breakout is a company releasing a good financial news, and this could have been it. This announcement could have been the good financial news, and the share price could have broken out above that level, $26.50, and if it coincided with really good volume, that would have been a really bullish sign moving forward. Unfortunately, this was not a bullish announcement, and the share price has struggled. Now, the other reason I did put this company onto my watch list is you can see the share price went on a run, and there was a nice day, a nice up day. On the 7th of December, share price rallied 7% on that day. And after that day, share price has been going sideways, consolidating just below that breakout level. That's what I'm looking for. I want to see the share price consolidate, go sideways, less selling coming in, lower volume as well, and then I wait, be patient and wait for the breakout. Unfortunately for Perpetual, this announcement did not cause excitement in the market, and it was not a breakout. A company I know nothing about, Sierra Rutile. I'm pretty sure Sierra in Spanish means mountain ranges. One of my favorite mountain ranges in the world is Sierra Nevada in California. Does it go all the way up to, no, it doesn't, just California. I prefer the Cascades, to be honest with you. In fact, I like the western third of United States and Canada. Apart from cities, I don't like cities. I love mountains. If you show me a mountain, or if you take me to a mountain, I'm going to be your friend forever. I love hiking up mountains, not the big tall mountains. I would never do Mount Everest, but I love the mountains, and that's why I know Sierra means, I'm pretty sure it means, it's Spanish for mountain ranges. Now, Sierra Rutile, no idea what this company does. What is Rutile? I have no idea what Rutile is. Now, I opened up this announcement, and the reason I'm talking about this company today is because the share price of this company was absolutely hammered on an announcement that was released on the 29th called Area 1 to be suspended following government decision. That does not sound good at all. So I actually did have a look at this announcement just to see what caused a bit of a stirred the market. And the reason this company is called Sierra Rutile is because they have their projects in Sierra Leone. Nothing to do with mountain ranges, although maybe there are mountain ranges in Sierra Leone. I actually have no idea. So you are dealing with a government of a country in Africa, and there is always going to be some sort of sovereign risk, always. And these sort of companies will be or should always be trading at a discount because of that sovereign risk. So Sierra Rutile Holdings has disclosed previously that the government of Sierra Leone has advised Sierra Rutile Limited, the operating subsidiary of Sierra Leone or Sierra Rutile. They have Sierra Rutile Limited, the operating subsidiary of SRX, that they are seeking to renegotiate the terms of the Third Amendment Agreement between Sierra Rutile and the government of Sierra Leone. Blah, blah, blah. Something about where we are. Where's the crux of this particular announcement? Okay, the Third Amendment Agreement is in relation to the fiscal regime applying to the remaining production from the existing Area 1 operations, and negotiations on potential amendments have been ongoing, blah, blah, blah. Additional, blah, blah, blah. Oh, God, they're taking a long time to get to the point. Here we go. The fifth paragraph, we actually get to the point. The position of the company is that the Third Amendment Agreement cannot be amended without the mutual agreement of Sierra Rutile. Reverting to the previous fiscal arrangements would make continuing operations in Area 1 uneconomic. So the market didn't like that, even though it took a long time for the company to get to the point, and that's why the share price of this company fell 51.5% on the 29th of January. Is this an opportunity to buy this company cheaper? I'd say no. That's just my opinion right now. I'm always looking at these massive decreases in share price because sometimes it does open up opportunities, but not these sort of companies. In fact, Sierra Rutile listed on the ASX back in July 2022, and on that day, share price reached its all-time high of around about 66 cents. Share price has decreased 60 or 90% since that all-time high, and this is probably not good news for the company. And more than likely, this is the last time I'll look at Sierra Rutile unless they release something really positive to the market. Now, what I thought might have been positive announcement was released by Ramelius Resources, because they released sort of an activities report for the quarter, but also in the title of this particular announcement, they put in financial year 24 guidance upgrade. Whenever I see the word upgrade, I get interested or intrigued. So this was a definition of an upgrade, maybe a profit upgrade, at least a revenue upgrade. So sometimes it could be a revenue upgrade, sometimes a profit upgrade, sometimes both. But what I'm looking for in particular is profit upgrades. And here we go. So here, I'll just zoom in. This could be a production upgrade as well. So we have production, revenue, but you'd think if there is a production upgrade, that should translate to revenue and probably transfer to profit. So they have increased their gold production for the year, their guidance for the year, and they've also decreased their all-in sustaining cost guidance for the year. So we have two positive things going for Ramelius. So I expected there to be a positive reaction from the market. So this company released this announcement on the 30th of January. How did the market react? Share price up 2.9%. I expected a little bit of a better reaction from the market. To be honest with you, I expected the share price to rally a little bit more. So let's have a look to see if this is a breakout opportunity for Ramelius. So not quite. Now, if you look at the long-term chart, so this is the daily chart going back to September of 2022. Share price has moved into an uptrend. So share price has increased from 60 cents back in October 2022 to current share price of $1.60. So share price has increased a fair bit over the past year and 3 months. But the share price has done really nothing over the past 4 months, been going sideways. And preferably, I'd like to see this sort of announcement just at sort of a stage where the share price is just below the all-time high or a long-term high. And unfortunately, the company released this announcement after the share price had been significantly higher for about 3 months. So there's a lot of pressure on the share price because a lot of shareholders bought in at higher prices and they might see the share price rallying, and you see extra supply of shares on the market because all these shareholders who bought shares at a higher price think this company is a dog stock, because the mentality among the majority of investors out there, and I should say investors, is that if the share price doesn't increase automatically straight away after they bought, the company is automatically a shit company. Maybe I shouldn't say that. A bad company, a low quality company, or a dog stock, and they want to sell immediately. So that adds extra supply of shares onto the market. And to meet that extra supply, you need higher demand. And to get higher demand, you need a really good announcement. So I thought maybe this could be that really good announcement. It wasn't good enough. And that's why the share price has not rallied. Maybe the share price will rally from now. Maybe a lot of those who want to sell out have now sold out. They've had an opportunity. So the other thing I like to look at is volume. We didn't see much volume coming in. So that's the other probably disappointing thing about Ramelius. Not a lot of volume coming in for this company. Next company is Mader Group. So I've been following this company for a while because shares in this company have been quite volatile, up 4.4%, 4.04%. So this company released a quarterly operational update, and every single time this company releases an operational update, it looks really good. Tell you what, it looks really good and really nice growth. And we saw nice growth this current quarter. So we're talking about, if we're looking at previous corresponding period growth, we look at percentage, which is sort of the fourth column here. So revenue Australia up 26%, revenue North America up 47%, rest of world revenue up 24%, total revenue for the company, for the group, up 31%, EBITDA up 37%, and looks like NPAT, or profit, they don't have quarter on quarter, they have half year. So a profit for the half year up 38%. So reads really good, but this company does have a sort of a high valuation and a lot of interest in this company. When I say high valuation, so Mader Group has a P ratio, I would say it's fairly high. It's got nothing here. Okay, so let's have a look at the last year. So revenue of 608 million, profit of 38.5 million, the previous year profit of 28 million. So let's just do some rough figures. Market cap of this company is 1.3 billion, which means the P ratio of this company, we'll say 4. So we're talking about between 30 and 40, P ratio between 30 and 40, but really good growth in the company. And what's happening, I think, over the past, say, 4 or 5 months with Mader Group, after the share price was on a beautiful uptrend. This is a beautiful uptrend. So if we look at the daily chart for Mader Group, share price had been in uptrend since 2021. Share price had risen from about just below $1 to $8. That's over a 2 and a bit, about a 2-year period. Beautiful uptrend in the share price. And I think the market was just a bit unsure about whether this company was overvalued. Even though the company was growing, the market was just a bit unsure. That's why we did see a little bit of a sell-off beginning in September. You can see there was a one big down day where the share price fell 10% in one day. Share price went all the way down to $5.60 and rallied nicely off that. Now, when the company released this particular announcement, I was surprised to see there was a lot of selling initially. I don't know why, because to be honest with you, it looked pretty good. But you can see that selling when we look at the 5-minute chart. Look at that selling. So just take it here. So the company released that announcement. Well, actually, initially there was buying. So in the first 20 minutes, the share price went on a tear. Share price increased from about, from about 670 to about 695. And then maybe someone dumped on market. Share price fell from $6.95 all the way down to about $5.75. We're talking about 5, 10, 15, 20, 25, 30, 35, 40, 45. In about 50 minutes of trading, share price fell a fair bit. We're talking about over $1, maybe $1.20. And then the selling stopped and the share price recovered quite quickly. And in fact, the share price is back up to the levels it was before the company released this particular announcement. I wish I was following Mader Group, because that share sell-off would have been really intriguing, because I've seen this happen a couple of times with Mader Group, where we have seen a bit of a sell-off And when the share price gets into this green area, so that's the long-term moving average channel, that's a buying opportunity. We saw it back in March 2023. We saw it back in October 2023, and the share price is now coming out of that level. Now, this is not a breakout or anything like that, because the share price has been significantly higher over the past 6 months, but this could be just buying a rapidly growing company at better value, that sort of thing. So still got my eye on Meta Group. City Chic, a company that's been hit hard over the last 3 years. And when I say hard, I mean hard. They released a trading update in response to media speculation. Probably a takeover or something like that. I actually haven't read this yet. But the market liked it quite a bit. So let's have a look. Without even looking at this particulars of this announcement, global sales revenue of 105.8. Significant improvement of revenue and margin in second quarter versus the first quarter. Well, probably should be, because the second quarter included Christmas. So you would think there would be an increase in revenue or an improvement in revenue. Material reduction in cost base from strategic actions taken. Underlying EBITDA loss, so they're still loss making. Inventory of approximately 39.5, down 27%. Net cash position of 3.5 million. That is a little bit of concern. So it looks like there's a lot of down numbers. ANZ, Americas, and partners. Do they have a table here? No table. And the response to media speculation was, City Chic is regularly involved in exploratory discussions with different parties regarding initiatives that could create value for its shareholders. And they're saying there is no certainty about that any of these opportunities, including potential sale of City Chic's North American business, proceed to a binding transaction. So possibly selling parts of the business or the business as a whole, potentially. Now, the market liked this. And to be honest with you, even though I've gone through this quite quickly, and again, it's based off expectations. So maybe, even though these numbers look pretty bad, a lot of down numbers, although there was a little bit of positiveness there, even though it does sound negative, possibly the response to media speculation, or just this media speculation, could have excited the market. And that's why the share price of City Chic rose 26.4% on the day, fell 6% on the Thursday, up another 7.7% on the Friday. Let's have a look at the chart. Is this a breakout for City Chic? Is this what I'm looking for? There's a whole reason I do this, go through this whole, this whole process, is I'm looking for breakouts. Ooh, okay. So this is the first time I looked at City Chic chart. This is awfully close to a breakout. Okay, so we put a line where the share price is right now. There we go, drew a line there. So the share price is now above the highs we saw back in January. So there's a nice little rally in the share price. Share price got up to 54 cents. The share price pulled back. Now we're in a rally. So this is a higher high. Now, the next thing I want to look at is the previous high before the one we saw in January. And that high was in August of last year. Share price went up to about 68 cents. You can see the rapid increase in share price. Now, that sort of rapid increase in share price is not sustainable. So it's not surprising to see the share price fall back. So it actually went into a resistance zone, not sustainable, no massive volume coming in as well. Now, the only problem with this potential breakout is the share price was higher back then in August. So we're right now at a 5-month high. So there will be a little bit of resistance moving forward because of these shareholders who now are possibly seeing the opportunity to sell out of this dog stock. And to be honest with you, this more than likely is a dog stock. But the share price is trying to rally right now. And we are seeing some good volume coming in the last few trading days. So better volume coming in, possible breakout. I'd say this is a possible breakout. It's really interesting. If City Chic didn't go on this rally back in August, say the share price just went up to, say, 50 cents and then fell back, this would be the definition of a breakout. And I would be more willing to buy some shares in this company as a trading position. If we see the shares get above 56 cents, they're right on 56 cents right now, possible trading position. So what you could say is if the shares do get above the highs we saw in August, so that would be about 66 cents, this would be a breakout. But I'm more willing to break this rule just because it is a 5-month high. More willing, but not necessarily doing it. Okay, One of my biggest weaknesses is sometimes I am too early. I am way too early sometimes on themes I'm thinking about, possible stories moving forward. This is true when it came to lithium twice. The lithium definitely true when it came to uranium, and possibly true when it comes to this company called Select Harvest. So I was thinking about 3 or 4 months ago that this company is going to benefit from rising almond prices in the next year because the California crop will be lower than expected, and improving weather conditions in Australia. That would mean better crop in Australia, which should benefit from for Select Harvest. So I took a longer term position in this company about 3 or 4 months ago on that basis. And then lo and behold, the company released something really negative. Really negative. When was that? Was it their full year results? It could have been the results back in November. And I can confirm this right now. Don't look at what happened last few days. So it was November. Yeah, share price fell from $4.37 all the way down to below $3. And that was back on the full year results. The market was negative. Maybe there was even an outlook in their results. So the share price took a bit of a nosedive. And then we saw the company release an announcement. And just the title of this announcement I just went, yeah, this is going to be a good announcement. Strong 2024 crop volumes and strengthening market pricing. So it seems like my thesis is starting to play out. I was just a little bit earlier, 3 or 4 months ago. I should have just waited for this particular announcement and jumped on it when I saw it. I'm not even going to open up this particular issue. Actually, I will. So this is exactly my thesis. It's playing out exactly what I was thinking about 3 or 4 months ago. They're talking about the crop, the current crop in like the Riverina area, so towards Mildura, is a good crop. And they're also talking about how the American crop is going to be a lower quality crop, and that should put some upwards pressure on almond prices. Do they talk about almond prices here? I think they probably should be talking about almond prices. Yeah, I don't know if they have. Based on a normal crop profile, Select Harvest net sale price is currently above $7.50 a kilogram and may increase further based on market demand. So things are looking much better for Select Harvest after a short period of time where things are looking pretty bad. And you can see that in the chart for this company. The market had the yips in regards to Select Harvest because of their full year results. So that share price just took a massive plunge. Share price fell all the way down to $2.70. And then just before this positive announcement, the share price was rallying. Now, I won't say that was loose lips. There's probably much smarter people than me out there who know there was potential for Select Harvest to issue a really good update to the market. And I wouldn't define this as a breakout either, because the share price, again, a few months ago was at these levels. But this is all about 6 or 12 months down the road, that this company's financials will be much better than they revealed when they released their results in November. So this is not a trading position. This is more of a longer term position. The share price will be significantly higher. What's the possibilities when I say share price could be significantly higher? Well, if you look at the long-term chart, share price could get as high as $13.50. Share price got that high in 2015. It's all based off the almond prices. I have no idea, but I think levels we saw. Look at that. Yeah, look at that. So at $2.70, the share price was at a 10-year low. So there was maximum negative sentiment in this company. And that's the time to get interested in these sort of companies. Okay, on to MoneyMe, which I am trading. I added to my position in this trade on the 30th of January. And then the next morning, the company released a trading update. And I went, oh no, did I time this absolutely terribly? Or did I time it pretty good? So let's have a look at the trading update. So this is probably one of those trading updates when I was a little bit nervous reading it because I did add to my trading position the day before. And now they started off the trading announcement saying they are pleased. Now, I have seen some companies use the word please in regards to an announcement when it's really, really bad news. So I never look at the word please and think this is going to be good, because sometimes it seems like management of companies can have no nuance about terminology they should use. You should not use the word pleased if it's a bad announcement. You should not be pleased to giving the market this announcement if it's a really bad announcement. So I don't look at the word please and think this is going to be good, but more than likely it's going to be good. MoneyMe continues to deliver statutory profits. Profit after tax at 4 million. So this company is profitable. Previous half year was 9 million, no, 3 million. Half year before that was 9 million. Gross revenue of greater than 105 million. Originations of 277 million, which was up from previous half year. Loan book balance of 1.2 billion. A lot of negative sentiment in these sort of companies. This is like an SME loan company. Founder-led digital lender and certified B corporation. Means nothing to me. Don't tell us what do you do here? We challenge the traditional ways of credit and simplify the borrowing experience with digital-first experiences that meet the needs of modern consumers. I want you to tell me what you do in the first. Leave that paragraph after you tell me exactly what you do. That's not telling me what you do. Anyway, they are a sort of like an SME lender. Anyway, so companies like this have been absolutely destroyed over the past few years. Still a lot of negative sentiment in these companies. You listen to Ausbiz, the core, and these companies are absolutely hated, but that's the time to like these companies when they're absolutely hated by the market. And I am seeing sentiment starting to shift in these companies. If you look at the weekly chart for MoneyMe, you can see the upside is $2.50. Share price right now is 9 cents. Well, maybe not the upside. Maybe the upside is not that high because I'm pretty sure this company's done at least one, maybe two capital raisings. I'm going to get rid of this 8 cents. Oh, that's when I bought. Yeah. So let's have a look at the daily chart. Okay. So I bought at 8 cents. Share price currently 9 cents. So I've added to my position at 8 cents. So share price took a little bit of a dip here. You can see this little bit of a dip on the 30th of January. And I added to my position at 8 cents. So I was confident that this was going to be a dip, sort of a buy situation. And I want the share price to get above 10 cents. And the reason I want the share price to get above 10 cents is if you just look at what the share price was doing a few weeks ago, it was really struggling to get above 10 cents. And the reason share price struggles to get above 10 cents is because that's a really natural resistance or support level. That's the point where shares, how much you can buy, what do you call it? The increase or decrease in the share price goes from being 0.1 to 0.5 cents. So below 10 cents, you can trade a company at 9.9, 9.8, 9.7, but above 10 cents, it goes 10, 10.5, 11, 11.5. So I found over the last 15 years, as I have been an investor, that 10 cents is a really powerful level. And you can see that power over a 5-day trading period between the 8th and the 15th of January, when the share price of MoneyMe was really struggling to get above 10 cents. Whenever it got to 10 or 10.5 cents, we saw selling coming in. And then we saw the share price dip. And I've seen it happen time and time again. The share price will test 10 cents again, and it might test it 3 or 4 times, maybe even 5 times, and then it will break out above 10 cents. And that's the time to get excited. So possibly I've mistimed this, and when it breaks above 10 cents, that's when I should maybe trade MoneyMe. But this does look interesting, this particular chart. Apart from the volume, I would like to see a little bit more volume coming in for MoneyMe. That's probably my only, wouldn't say red flag, but the only thing I'm looking for here is some higher volume for MoneyMe. The next two companies are sort of linked, Perenti, and the reason they linked is because of this announcement. On the 31st of January, Perenti released an announcement that says they're in support of IGO through the Cosmos transition. I'm not sure if Independence Group is traveling throughout the universe, the Cosmos, or maybe Cosmos is just one of their projects. I know nothing about Independence Group, apart from they do have lithium. They are a lithium miner. So do they mention anything about Cosmos project? Here we are. Cosmos project update, a lithium business update 2 days previous. So I have actually not had a look at this particular announcement. So why are they talking about the Cosmos project? So as a result, for some reasons, probably because of deterioration in commodity prices. So they say here, In parallel, commodity prices, don't know what parallel it is too, commodity prices have deteriorated significantly since the review commenced, impacting the economics of Cosmos. So I'm pretty sure this is more than likely a lithium project. That would make sense. As a result, IGO has made a difficult decision to transition Cosmos into care and maintenance. This is what we're looking for in terms of lithium. We want more and more lithium projects, particularly if they're in production, to be put in care and maintenance. This is telling us that lithium is nearing a bottom. More and more of these lithium projects are being put into care and maintenance. This is a good thing moving forward. This makes me more willing to buy lithium producers like Pilbara Minerals, because we are now going to see a decrease in supply of lithium on the market. This is a good sign for lithium in the longer term. Maybe not for IGO. How'd the share price go? Oh, share price did nothing. So the market probably expected this from IGO. So this did not surprise the market. However, I did notice when I look at Perenti, you notice Perenti share price nosedived about 5% on the day when they released that announcement. So Perenti shareholders didn't like this announcement, that they're supporting Independence Group through their Cosmos transition. And the other thing I noticed when I looked at the chart for Perenti, share price has fallen a fair bit. So let's have a look at the chart for both of these companies. First with the Independence Group. And you can see how much deterioration in lithium prices has affected Independence Group, or IGO, I should say. They used to be called Independence Group. Share price has fallen from $16 down to $7.29. Share price in a well-defined downtrend. Let's have a look at the weekly chart. Share price now at levels we saw back in 2021. So important level for Independence Group would be probably the really important level would be the COVID-19 lows. So 340, that's still a fair way to go from here. I'm not sure. I don't think IGO will get to that level. And maybe the highs just before that were at about $6.60. So the highs just before COVID-19, that is another interesting, important level. And looks like possibly IGO Group bounced off that level a few days ago. Let's have a look. 5-minute chart. Oh no, it bounced off it on the 22nd. Oh, perfect bounce off it on the 22nd of January. Quite volatile. You can see the share price. The market is a really interesting reaction from the market when you look at the 5-minute chart. So when they released that announcement on the 31st, share price opened down 7%. And then about an hour later, just under 2 hours later, the share price was up. Share price went from $7 almost to $8. So the share price rallied over 10%. I'm not sure what happened, and the share price has gone back down. What caused that excitement in IGO over that 1 hour, 2 hour period? I don't know. Anyway, so just by looking at the daily chart for IGO, no buy, and it's just bounced off that very important support level, which was on the 22nd of January. So we're talking about a few weeks ago, like a week and a half ago. So if the share price at IGO Group falls below that, that would be a bearish sign. Now onto Perenti. I don't really follow Perenti all that much. I do know it used to be called Ausdrill. So they're into drilling. And remember, I've already talked about Mitchell Services. And I do know there are quite a few drilling services companies on the ASX. And a few of those companies have bought other companies, like Perenti bought DD1H or H1. So we have this Perenti, Mitchell Services. We have some smaller drilling companies as well, like Dynamic Drill and Blast, whatever that's called. But I wasn't following Perenti all that well. But a few weeks ago, I did notice that Perenti had a breakout, and a bad breakout to the downside. That was when share price fell below about 98 cents. That was a support level, a fairly important support level. And the reason that was support, you can see how many times the share price of Perenti hit 98 cents and remained above it. So we're talking about 1, 2, 3, 4, 5, 6, 7, 8. On the 9th time, it tested 98 cents. It did a little bit of bounce, and then it fell straight through, and then it just collapsed. So share price went from 98 cents to 81.5 cents on strength. And the reason it does that is because when you see the share price break down below that support level, you're going to have all these traders who may have bought into Perenti expecting a bounce, no matter how much that bounce is going to be. And when it didn't bounce and the share price fell, they got out en masse. And that's why we saw the share price just collapse after that. Weekly chart for Perenti, let's have a look. Is it at interesting levels? Not really. Yeah, no interest in this company right now. Probably the only interest I probably would get from Perenti is if it gets down to that level there. The reason that's an interesting level is because that's the lows during the COVID, not the lows, but that's sort of a level we got to during the COVID-19 financial panic, and also the lows we saw back in July 2022. So we're talking around about 55 to 60 cents, and the share price has a lot to go before it falls to those levels. Doesn't mean it won't, but still a fair bit to go. And if the share price does get to those levels, I could become interested in trading Perenti. Next company is a company I know nothing about. FFI Holdings. I don't know anything about this company. Share price is $4.52, right? But the market cap of the company is 48 million, which means the company has about 10 million shares on issue. It's not a lot of shares on issue. They have a dividend yield, 2.2%. They have a P/E ratio of 28. So this company is profitable. So according to the summary in ComSec, sounds interesting. Bakers and pastry cooks, ice cream and dairy, confectionery, chocolate, and supermarkets for the Australian market. So manufacturing, packaging, and distribution of food products. I don't like those sort of companies, to be honest with you. Anyway, so why am I showing you FFI Holdings? They released an announcement that was titled Profit Guidance. I am always going to be interested when a company releases an announcement that is titled Profit Guidance. I always have a look at it. And that's exactly what I did with this particular announcement. And nothing too exciting here. So they expected to report a net profit of before tax of approximately 2.39 million. Why not after tax? Why before tax? Approximately 2.39 million for the half year. The net profit before tax for the previous corresponding period was 0.626. So a massive increase in profit, a 400% increase in profit from the previous corresponding period. The improvement in the result reflects the success of the initiatives the company has implemented to improve profitability and address the issues that negatively impacted profit in recent times. Cakes and chocolates. Making me hungry. Okay, let's have a look at trading view. I just want to look at the history, financial history of this company. So we can go back to 2019. Revenue has increased from 32 million to 47 million. They had pretty good profit. 2021 profit of 8.7 million, 3.4 million in 2020, 1.2 million in 2022, 1.7 million in 2023. And if you just look at the chart, I thought this company would be more illiquidly traded. Yeah, if you look at the daily chart, there is a bit of liquidity here, but possibly the downtrend we did see has come to an end. Sort of looks interesting. Some good volume coming in as well. I don't know. Yeah, I probably would not be that interested in this company. Not a breakout, what I'm looking for. But there's a company I know nothing about until now. FFI Holdings, they make and sell cakes and ice cream, stuff like that. Now, a company I know a little bit more is Prophecy Group or Holdings. They did release a positive update. First half, financial year 24 business growth update. Company I've been following for a long time, in fact, and things are moving in the right direction for this company. Have a market cap about 50 million, so just like FFI Holdings, but I'd be more bullish on this company because this company is a software company. They have two main products, Emite and Snare. I think Emite is the more promising one, but revenue's up 29% to 11.64 million. Result reflects sales growth driven by diverse new customer wins across both Emite and Snare, with significant momentum in the Middle East. What's happening in the Middle East? Go, you good thing, in the Middle East. 21% analyzed recurring revenue growth to 24.9 million. They don't mention anything in regards to profit. Or they do mention closing cash balance of 9.9 million. Is that higher than previous year, as at 31st of December, to be break-even year on year, with cash to 10.9 million at the 29th of January. So in 1 month, the cash balance has increased by $1 million Have another 3 pages here. Business momentum, Emite performance, have some pretty good quality clients here. Australian Tax Office, Cochlear, Macy's, Abu Dhabi Commercial Bank, Dubai Health Authority, Dalah Health in Saudi Arabia. What's happening, United Arab Emirates and Saudi Arabia? Why do you like Emite? You like Emite. And Snare, talking about Snare as well. Anyway, the most important thing about this was the market reaction. Market liked it. Share price up 10.7%. Share price on a little bit of a run right now, but is this a breakout? The more important breakout I am looking for. Not quite. Oh, not quite. Share price going sideways. There is a little bit of liquidity in there as well. I do like these companies. And if this company can maintain this momentum with a market cap of 41 million, I thought it was a little bit higher than that. I thought it was more like 50 million. 41 million, if this company can maintain this momentum in the Middle East, go United Arab Emirates and Saudi Arabia, if they can continue releasing good financial results or numbers, this eventually will be a breakout and the share price will move into an uptrend. But I can't call a breakout just yet. Why? Because the share price was higher in August. 15th of August, share price was slightly above these levels. Not much above these levels. So what would I be looking for in terms of breakout? If the share price gets above 66 cents, which is not much higher than it is now. Now, the other thing you notice when you look at the volume for this company, you can see spikes in volume. I want to ignore spikes, not Buffy spike, but spikes in volume because that could be just sort of a cross trade, that sort of thing. One institution buying a block of shares or something. What I want to see is volume spikes where we did see in the last few days, which is sort of, you can't really see it because of these other bigger spikes in volume. But the good thing is share price consolidate going sideways, a good financial announcement from the company. So things are looking better for FFI Holdings. And the reason I say that is because the share price did take a massive dive after a nice little rally in the share price back in late 2021. So I need to see share price breaking out on positive financial news, and I would like to see some good volume coming in. In fact, probably the best thing to do in regards to FFI Holdings, in regards to volume, I said regards twice, I think, is to look at the weekly volume. You can see a bit of a spike in volume in the past week. A little bit of a spike, but nothing like we saw back in late 2021. So that's FFI Holdings. Next company is Singular Health. Now, I'm pretty sure I mentioned Singular Health when I did my January 31st Appendix 4C video, whatever that was titled, because they released their Appendix 4C at 4:31 p.m., which is about the time I recorded that video. So I might have actually mentioned Singular Health, and I was not interested in that particular cash flow or Appendix 4C, because when you look at the numbers, there was nothing too excited to get when you look at the numbers here. So $421,000 in receipts. Company was operating cash flow positive, $251,000. But the reason they were operating cash flow positive was because they received $977,000 in government grants and tax incentives. And in my opinion, this is my opinion, government grants and tax incentives don't belong in cash flows from operating activities. It's not operating activities that generate that cash. It's government grants and tax incentives. That belongs in the financing activities, that sort of section. It gives a distorted view to how the company is performing. If you just look at operating cash flow, 251,000, it wasn't 251,000, but that's off topic. I should have had a look at the chart for this company because at this point in time, someone loved or was loving this company. Share price was going on a tear. And then the company released the next day, the company released an announcement titled First Enterprise Sale in United States Medical Education. Okay. I typically don't get too excited about these sort of announcements. A 2-year contract with Roseman University of Health Science. I've never heard of Roseman University. And to be fair, I've heard most of universities in America. I've never heard this one. With purchase order received for 50 I don't even know what this company does. 50 3-di-cum R&D licenses and 5,000 3-di-cum patient licenses for a total value of approximately $152,000. Doesn't sound a lot. but maybe this is what the market was looking for. And maybe I should do a video on this company. I'm going to write that down. I should do a video on this company because, not because of this announcement, but just because of how the market reacted. You'll see that in a second. In fact, let's have a look at the trade history. Here we go. Share price rallied 60% on the back of this announcement. But look at the volume, 7 million shares traded. Look at the volume some days during the past few weeks. 19,000 shares traded on the 25th of January. 2,000 shares traded on the 9th of January. There were some days where we did have some high volume coming in. 12th of January, well, the share price rallied 50% on that day as well. What happened on the 12th of January? Let's have a look. First 3 Diacom enterprise sale received in the United States. Okay, so I'm sort of understanding what's happening now with this company. Any numbers here? No numbers. First enterprise, 5,000 licenses purchased by TechWorks for good on behalf of US veterans. Ooh, US veterans. I do know that. Charlie Golf 1. Oh, it's interesting. Oh, yeah. So let's have a look at the chart, and not the weekly chart, the daily chart. So something good is happening with this company. So share price rallied on the back of that first announcement in early January, or the 12th of January. Some big volume coming in, and then this secondary announcement, the share price rallied another 50%. So in fact, we have seen the share price of this company climb from 4 cents to 13.5 cents. And that is even after the share price fell 10% on the 2nd of February. So there is interest in this company right now. The company has released a couple of really intriguing announcements that has excited the market. And just look at the volume, massive increase in volume. So that's the main reason I'll do, more than likely, I will do a video on this company because of these announcements that have been coming through from Sinclair Health. But if you look at the weekly chart, share price has been down a lot. So company listed on the ASX back in February 2021, share price went as high as 75 cents. So share price of this company is well below the highs, and the market cap of this company is still quite low at $13 million. So there could be still significant upside left for this company. So just think, the share price has increased threefold from 4 cents to 13 cents, which means the market cap of this company at the start of January was like $3 or $4 million, not that high. So you can see the benefits, the advantages of microcap companies. One positive announcement can drive the share price significantly higher, but you need that positive announcement. Now to a few announcements that were released today. I just had a quick look before I started this video. The first one is Atturra. Nice little 4.3% rally. Atturra to report strong first half results. I like the sound of that announcement. So this is a software company, I believe, providing a range of enterprise, advisory, consulting, IT services and solutions with a focus on local government utilities. So maybe not an IT company. Oh, they have, as a client, they have Snowflake as a client. I'm a shareholder of Snowflake. So in a way, Atturra is working for me. So in a way, in a really weird, twisted way. Anyway, so let's have a look at the numbers for Atturra and this particular earnings update, or this profit upgrade, or whatever you want to call it. Revenue between 108 and 112 million, up 30%. Underlying EBITDA between 10.5 and 11.5 million, up between 15 and 26%, up from 9.1 million in the previous corresponding period. Earnings before interest and tax between 5 and 5.5 million, so down 29 to 35%. Why is EBIT down and EBITDA up? So what's the difference between EBITDA and EBIT? It's depreciation, amortization. So there must have been a big increase in depreciation, amortization. That's right, this company acquired Cirrus Network Holding, so might have something to do with that. Okay, they actually do mention here. Primarily the result of large one-off costs exceeding 2.6 million associated with merger and acquisitions and integration activities because of the acquisition of Cirrus Network. So it is probably wise to disregard that EBITDA number, focus on EBITDA because that is a one-off. Now this company does have a high market cap, if I remember correctly. 220 million. I'm guessing 220 million. Let's have a look. 188 million, so a little bit down. Price earnings ratio 17.7 million. And share price not doing anything. Share price going sort of, if you look at the daily chart, share price is just slowly grinding downwards. You need some volume coming in. You need some institutions getting excited about this company to drive the share price higher. I actually did want to do more research on this company because the share price was in an uptrend from when they listed all the way through to start of 2023. But since the start of 2023, so over the past year, the share price of this company just been going down slowly. And you can notice if you look at the one-day candlestick today, there was a little bit of selling that came in. So at one point, the share price got as high as 92 cents and the share price finished at 85. And the reason behind that, you won't probably see in the 5-minute chart because you do see it a little bit. So share price high was actually reached at about 1:20 p.m. and a little bit of selling coming in that drove the share price down. You might be able to see if you look at the depth. Yeah, so if you look at sell on the sell side, we have someone wanting to sell shares at 85 cents, someone wanting to sell shares at 91, someone wanting to sell shares at 91.5 cents. So if that first sell bid gets taken out, you can see the share price of this company rally 10% quite easily after that. So not a lot of buyers and sellers. Probably a company I would be more willing to buy if the market cap was a little bit lower, if I saw more value, just because the company's growing. I thought they were a software company, but maybe not. Company is growing and they're profitable. That's two main things I'm looking for in these sort of companies, but I want some value there as well. So Atturra, might do more research. Pentanet is the other one. 5, GG. Company hit hard over the past few years because this company has not been profitable. Share price did rally 15.8% today on the 2nd of February. So today not be today for you if you're watching this video after the 2nd of February. The company did release their Appendix 4C on the 30th. It was okay. Don't think, if I remember correctly, they were operating cash flow positive. Did I put this company on my list of companies to do? I did not. Yes, I did. 5GG is, you will see a video on 5GG eventually because they were operating cash flow positive, 517,000. However, they were not free cash flow positive. So get from operating cash flow to free cash flow, you take the operating cash flow and subtract the property, plant, and equipment or capital expenditure, which was 876,000. And because 876,000 is greater than 517,000, the company was free cash flow negative. And you see a similar theme in their announcement today. But for some reason, it seems like the market react. Yeah, they sort of did react. Actually, when did they release? So interesting, they released the Appendix 4C on the 30th. On the 30th, the share price decreased 9%. So initially, it seems like the market didn't like this announcement at all, or this Appendix 4C, don't know why. And then the next day, share price rallied 7.7%. And now the share price has rallied another 15.8% when they released this investor update. So I thought maybe it was on this investor update that the market got a little bit excited. Nothing really new in this, but they do mention they were EBITDA positive in the second quarter. No, slightly negative. They were positive. What were they positive in? They were positive in something. Might have to go to the points. EBITDA positive, break even maintained across first half. But then if you EBITDA positive, I saw something else, EBITDA positive. Cloud gaming EBITDA positive. Maybe that's what I saw in terms of being EBITDA positive. Gaming EBITDA positive. EBITDA positive achieved in second quarter of financial year 24. Yes. So slightly negative for the group, but gaming is EBITDA positive. So this company is right on that important inflection point. So is this a breakout? Is this what I'm looking for? That breakout? Not quite. In fact, share price still in a downtrend, well-defined downtrend. It's been going on for a long time. This is the definition of a downtrend, but possibly the low has been reached. So the low in the share price for this company was in October. Share price got as low as 4.4 cents. Then the next low was higher. The next low was 5.2 cents. And the next low after that was 5.2 cents. Actually, 5 cents. So maybe a little bit of a bottom being reached here. But share price at 6.6 cents. Last time the share price was that high was not that long ago. In fact, it was the 13th of December. And before that, it was the 31st of October. So, yeah, not a breakout what I'm looking for. Some good volume did come through today, but this is, you might see continued volatility in the price or share price of this company. What I've been looking out for when it comes to Pentanet, 5GG, is the next quarter result. So we have 3 more months. And if the share price can go sideways, and if the share price can remain around about 6 to 7 cents, and if the company can release an Appendix 4C and they can show the market they have gone past that inflection point and they are now operating cash flow positive, free cash flow positive, EBITDA positive, that might lead to a real breakout in this company's share price. And that sort of breakout I will be looking for is a share price getting to say 8 or 9 cents on high volume. If that happened, that would be a breakout. In the meantime, we can't see the share price get to those levels and stay those levels, then pull back before that breakout, because that would lead to some resistance moving forward. Now, the last 2 companies I want to talk about, I'll talk about the good story first, and that is a company called Australian Potash Australian Potash Limited. So this company was in an administration. So appointment of voluntary administrators in December. And so a lot of people, a lot of investors will be thinking, that's it for this company. There's no more. And then on the 2nd of February, which is today, APC to exit administration after credit approval. Out of administration at 1:54 p.m. Not trading yet. And the good thing about this particular announcement, if you can see it here, cessation of voluntary administration, company return to the control of the board of directors. I don't know why they've got some money or something like that, but just because a company you own is in administration doesn't necessarily mean that's the end of the company. And here is proof. Australian Potash. Let's have a look at the chart first. Ew, that's an ugly chart. And this is a reason why trading could be a good thing, because would you be a sharer of this company if you are solely trading companies? You'd be not owning this company at all. So those only owning this company would be those who were positive about the future of the company, or those who bought in back in 2021 at 20 cents, say, and you just maintain a holding because you don't want to sell at a loss. So you just see the shares going down and down and down, and you're feeling a loss. If you're a trader, there's no way you'd be holding this company. There was no way you'd be holding this company during this little 1 month stage at administration, actually 2 month administration stage. So that's the positives, benefits of just trading. You don't own these sort of companies. Now on to the bad news story. A company that looks like it's going bye-bye, and that company is Halo Food. I'm pretty sure I did a video on this company, because when I looked at the 3-month announcements, they mentioned here somewhere divestment of Healthy Mummy, and I'm pretty sure I talked about Healthy Mummy. So they went into a voluntary administration back in August, so we're talking about 6 months ago, and now they have just released an announcement, appointment of liquidators. That does not sound good. Seems like the company is going to be completely liquidated, and there's no way liquidation can be a good thing, I think. So Michael Corder and Robert Hudson were appointed liquidators of the company, and I suppose they're going to sell everything. We confirm that the liquidators have put in place arrangements to respond free of charge to members and creditors' queries in relation to the consequences and progress of the external administration. I could be completely wrong. Maybe liquidators do something completely else apart from completely selling everything in regards to the company. Maybe they have something else in mind. I have no idea. But anyway, just like Australian Potash, why would you have been owning these companies? And again, positive of being a trader is when you look at this chart, it's an ugly chart. And actually, the other thing I should mention is if you look at Australian Potash, whenever you see this, you see a couple of times the share, actually 3 times the share price rallied. And when the share price rallied into this, see this red shaded area with that blue line through the middle, that's the longer term moving average channel. That's also a resistance channel, resistance zone. The reason it's that resistance zone is quite evident when you look at both Australian Potash and Halo Foods. You can see back in October 2021, share price rallied into that area and then pulled back. In April 2022, share price of Australian Potash rallied to that zone and pulled back. In April 2023, share price of this company rallied into that zone and then pulled back. So 3 times the share price rallied into that resistance zone and then pulled back. That's the time to sell if, unfortunately, you were a holder of this company. Same thing happened with Halo Foods. Now, this is not absolutely true for every company. Every company is different. But you see the same signal for Halo Foods. It's only happened a few times, but it's happened. Back in November 2020, it rallied into that resistance zone and then pulled back. It almost rallied into that resistance zone in April 2021. Didn't quite get there. It did rally into that zone in November 2021 and then pulled back. Rallied again in February 2022 and then pulled back. And since then, not rallied. It's been ugly, ugly for Hello Foods. In fact, the share price of this company has fallen from as high as 70 cents to 0.7 cents. So this share price of this company has fallen 99% since 2019. They might have been called something completely different back then. I don't know, but an ugly, ugly looking chart. Hopefully, you're not a shareholder of this company because it looks like maybe you have nothing to sell. Anyway, that's all I've got for this another long video of interesting announcements that I've seen being released during the week. If you have any thoughts, any questions, leave those in the comment section of this video. Otherwise, that's it for this video. And more than likely, I'm going to release this video on the February the 3rd. That's it for today's video. Have a good day. Bye.